So this is the 8-week retirement presentation, and it's an opportunity to learn about the process, how to retire well, how to retire successfully, how to retire happy, wild, and free. And so as a reminder, please mute yourself. And again, put your questions in the chat. We'll address them at the end. Let's get started. So who am I? My name is Mike Finley. I reached financial freedom at age 45. I haven't had a job for 15 years. I had graduated. So the term graduate, I don't really like the term retirement. Graduate means I've graduated to the next best phase of my life. And that's how I'd like you to start thinking about this issue. This isn't about retirement and doing nothing. It's about graduating to something better, something that you truly want to do that will give you purpose in your days. This is not about IQ. It's not about making a lot of money. It's not about coming from the right family. I have an average IQ. I didn't make a lot of money, and I didn't come from the right family. I grew up poor. But there was a time in my life where somehow, some way, a book came into my life that changed my life. It was a financial book, first financial book I ever read. And I realized at that moment that I was doing everything wrong. And this guy said I could do it myself. I could be my own financial advisor. And that was my beginning. And 35 years later, I'm here helping you see the path. So I zigged when others zagged. And all that means is when I looked around my life, I saw a bunch of people living paycheck to paycheck, going nowhere with their finances, just barely getting by. And I came to the realization that if I kept doing what they were doing, which is what I was for the first 7 years of my working life, I would end up in the same place, stressed out, no money, a lot of debt, trying to figure out how I got there. And so that's when I changed. That's when I started looking for the opportunities in my life and seized on those and started changing. And I started finding the right teachers, and the teachers were not in front of me physically. They were in books. And so while I'll be sharing books with you and other information, I want you to know that there's a litany of people out there who are ready and willing to help you with not just your money, but your life. So at the end of the day, I looked at what was in front of me and I took advantage of what I could. And my message to you is, so can you. Because this is a transformation. You transform into a different, better version of yourself. And that's what I did. I didn't realize it at the time, but I was transforming into a very different version. What I ended up becoming was the crazy man in the pink wig. That's what I go by today. I help people understand that if you go down this path that I teach, you could appear to be weird, strange, maybe even crazy. But what it might represent is you're on the right path, which is your path. So don't be afraid to be doing it in a different way than what the crowd is, because the crowd is broke. The crowd is living paycheck to paycheck, hoping to have enough money to pay their bills. I reject that message. I reject that way of living, and I encourage you to follow a different path. So be open to change. Each week, I'm going to be sharing information with you. Be open to this idea that it could contradict some information that you thought you knew. I would encourage you to go to the Finheads Facebook page, become a member. That's our community. And I share quite a bit of information periodically throughout the month, helping you better understand the world of money. Sign up for the free monthly newsletter. You can find that at thecrazymaninthepinkwig.com. That's my website. It's my for-profit website, thecrazymaninthepinkwig.com. That newsletter comes out every month. There's a blog on that website, which shows the previous newsletters on there. And again, all of this is built to help you better understand not just money, but life. Start reading. So I'll be recommending books every week. I encourage you to start digging in and reading about some amazing information from some amazing people. That's how I became whoever I am today. And I continue to read and I continue to change. And I encourage you to do the same. You can tune into my YouTube channel, Crazy Man in the Pink Wig. You can look me up. Plenty of videos on there. You can listen and watch on your own time and schedule. So, retirement, it's financial and psychological. Sometimes we kind of forget that psychological piece, but I'm here to tell you it's a big piece of the puzzle. The financial piece is basic math, and I can help you with the math. I did the math, and that's how I was able to retire at 45. But at the end of the day, you got to go beyond that math. Because when the math works, that means you don't have to work. Now, you may choose to work, but you don't have to work. Then you're going to work because you're choosing to, you want to, not because you have to. And this is where it's time to graduate. You graduate to something else that you want to do with your life, something better, something more fulfilling, something that gives you the kind of purpose that you get excited about waking up to and taking on the day. But this psychological piece is something we also want to pay close attention to. I'll be referencing that throughout the next 8 weeks, and I encourage you to really think carefully about this issue. What are you going to do after graduation? Who are you going to be? These are big questions, and the time to be asking yourself and exploring this issue is prior to retirement, not after, prior. And I take a moment and read this. Walt Mossberg had it right. You get to reinvent you. And in some ways, I would tell you, you might just be able to go back and figure out who you really are. So, round up the portfolio. Time to do some math. How much do you have? What is your liquid portfolio?
I can't eat any more chicken.
Go ahead and mute yourself, folks.
Got a feather back here. I got a feather back here. So
Go ahead. Go
too
ahead.
much of the chicken.
Folks, go ahead and mute. So, how much cash do you have in the bank? That's part of your portfolio. Mutual funds, stock mutual funds, bond mutual funds. How much do you have in that? How much do you have in individual stocks, cash value life insurance, annuities? How much do you have? Round up all the money, everywhere it's located, and identify that big number. And then, of course, you're looking at IRAs, Roth IRAs, 401ks, savings in the bank. You're looking everywhere, including if there's money in a safe in the house. Take your time, make sure you've identified all your money, including any old retirement plans that might be out there, just hanging out there from previous employers. And then you want to take some time, and this gets harder. You want to identify the investment cost that you have with each of your investments. So what is the cost of each mutual fund you're paying for? What about the advisor? How much are you paying an advisor? What is the total fees that you're paying on all of your investments? Most people don't know that. I encourage you to dig and find that out. And if you can't get straight answers from an advisor, for example, well, you have the wrong advisor. On the other hand, identify your mutual funds. You can take their symbols, type them in Google, and you can identify if you have a load mutual fund, meaning a commission, and identify the expense ratio, which is the fee that goes with each mutual fund. And when I say uncomfortable conversations, well, they can be, right? When you're talking to a financial advisor or a life insurance agent, and you start talking about fees, they kind of squirm because they realize you're starting to educate yourself on the cost of your investments. And most of the financial industry would like you not to focus on that. They would rather you just give them your money and go away. Well, I'm here to tell you that's a mistake. It's time to take control of our money. So, are you going to keep the money where it is? Is that your plan in retirement? Or are you going to transfer it to a place like Vanguard? So, that's what I did. I transferred all my money to Vanguard into low-cost index funds and a money market fund. Why? Because I cut my fees dramatically, and so can you. And that is basically the same advice that a guy by the name of Warren Buffett recommends. So at the end of the day, you're trying to figure out where best to keep your money as you enter this next phase of your life. Where is the current portfolio, right? What is your current asset allocation? That means how much do you have in stocks and bonds and real estate and cash? What is it now? And why are they allocated the way they are? Have you allowed some guy to do it for you or woman? Or have you done it? And why? How have you put it
Hi,
together?
what's
And
the
what
code to the
you think
bathroom?
it is?
Scotty, the number's right up there where it's
Go ahead,
five
mute
pound.
yourself.
Okay.
Ladies,
What's the code to the
mute
bathroom?
yourself. Mute yourself. Hit the mute button, folks.
Nobody wants to hear your bathroom discussion.
Hit the mute button, folks. Okay, are you happy with that mix? And are you sure you have it where you want it to be, right? So again, identify what your mix is. And then are you happy with that? Usually when I ask this question to people, they usually don't know their asset allocation. And then when I ask them, are they happy with it? They look at me like, am I supposed to be? So this is the time to explore, to get the details of where your money's at and what it's costing you. What would you like to see as your future asset allocation?
Sounds
So
like
you
it
know
was that
where it's at
phone.
now. What do you want it to look like in the future as you take that leap into your next phase of life? So here's an example. Say somebody has $500,000. And this is a fairly normal example for a lot of people with a portfolio roughly of this size. They might have about $318,000 in their 401k, and their yearly cost on that is $41.34, and that means 1.3%. That's what they're paying in fees. They might have a Roth IRA. Maybe their fees are 1.8%. They could be paying an advisor, for example. They could have an old traditional IRA. Fees in that. A non-qualified annuity. So they got sold an annuity by some insurance agent. And as you see, the annuity fees are very high. So we're looking at the dollar amounts and we're looking at the percentages as we go along. Cash value life insurance. We have an old cash value life insurance policy from way back when. Well, that has fees too. They're ingrained in the products. In other words, folks, just because you don't get sent a bill doesn't mean you're not paying. I promise you, you're paying. People in the financial industry do not work for free. Bank savings. How much? Yes, you're not paying any fees, but in essence, you're losing a great deal because of inflation. So if your bank savings isn't earning anything, you're losing money. The sock drawer, safe, wherever the case may be, right? Where do you keep your money? If you have any money sitting in the home somewhere, safe, keep in mind, inflation is eating it up. There's also a thing called opportunity costs that could be hurting you. So be mindful of that. So in this case, this individual did their research. They found where all the money was at, and they identified that their portfolio was about 25% stocks and about 75% bonds and cash. Yearly costs came in around $7,356. That may look like a small amount on $500,000, but it is not. Here's example two. Here's one way you could change the dynamic of that portfolio. So now when we graduate, we move that 401k to an IRA at Vanguard, paying that fee and that percentage. We move our Roth IRA to Vanguard into index funds, paying a lot less. We move the old traditional IRA to the Vanguard traditional IRA, paying a lot less. We move the cash that's sitting in the bank or the home into a brokerage at Vanguard, making money. Cash value, we empty out. We don't need it anymore. Bank savings, nope. We keep our savings at Vanguard in a money market fund that's earning 5.28%. Sock drawer, nope. We understand that it's losing money to inflation. We get it working for us. And now we've changed our allocations to 75% stocks and 25% bonds and cash. Why? Because we want to stay ahead of inflation. We want a decent rate of return on our money, so the money lasts longer than we do. Yearly cost, $299. So that's a difference of over $7,000 a year. And that's a year. We start adding that up. Stock allocations went from 25% to 75%. This will dramatically increase your returns over time. These two changes could very easily see a difference of 5% or more of growth in a portfolio over time. And again, that's per year. So how important is that? Well, let's look at some numbers. 500,000. If you had 500,000 and you had earned 3% on that amount for 10 years. So why did I choose 3%? That's about what a portfolio of 25% stocks, 75% bonds and cash previous would have earned versus an 8% return on a 75% stock allocation with low-cost index funds. So those are returns after 10 years, and then the same numbers, 3% or 8% after 20. What does that 500,000 do at 10 years? Well, somebody looks at that and they think, hey, I got $671,000, except it could have been over $1 million. At 20 years, you might think, hey, I got 903. Yeah. But look what it could have been.
Wow.
$2.3 million. So when I say this is math, folks, I mean this is math. You want to put the math on your side. And you can do that. And I'll help you. But you've got to start digging and understanding where you're at now before we start to put you in a better spot later. Okay, what is 4% of the portfolio? Well, this is an important question. We'll talk about the 4% rule as time goes on, but you want to identify how much you have in liquid assets, and then what is 4% of that number? Account for every liquid dollar you have. Again, make sure you've identified all the money you have that makes up your portfolio. And then what is that number divided by 12 months? Start tracking that number. In other words, what is that on a monthly basis? This is the beginning. Again, I want you to dig. I want you to identify all the facts of your portfolio, because this is going to give you peace of mind. It's going to give you the knowledge and the courage to take this next step of graduating beyond the world of work. So fixed income. Do you have a pension? What are your options? When are you going to take it? Why are you going to do it? So all these issues we're going to be talking about over the next 8 weeks. Your job right now is to try to get more details as it relates to your situation. What are your Social Security benefits? So what is your benefit at 62, full retirement age, and 70? And then what is your Social Security strategy, either as an individual or as a couple? We all need a Social Security strategy, which we'll talk about in the coming weeks. Do you want to buy an immediate annuity? What that means is basically buying a pension. Do you want to buy a pension so you have a certain amount of money coming in every month for the rest of your life? And if so, how much? Will you have the TIA traditional annuity? So if you work at UNI, Hawkeye, or other institutions, colleges, universities, Many of them will have the TIA traditional annuity where you could have it pay out over 10 years. Pay out every month, once a year. That is also a form of a pension. Will you have part-time or full-time work when you graduate? In other words, will you work nothing or will you do something on the side? And if so, what do you project that income to be? So we want to know your fixed income as best you can as you prepare for this next phase of your life. Monthly and yearly expenses. What are they? And again, this will give you peace of mind. This is a very important bit of information that you want to pull together as you prepare for this next phase of your life. What do you expect those expenses to be in retirement? Sometimes you'll hear people talk about 70%, maybe 80% of what your expenses are while you're working. I would recommend you basically use 100%. I would not expect your expenses to go down. What tends to happen is people just spend money on other things. So plan for 100% expenses when you retire. And if they're less, you'll come out ahead. But if they're up to 100%, you'll be glad that you planned for that. It's very, very important to get these numbers down. These numbers will be used to work off as we plan and prepare. At the end of the day, you're trying to retire, trying to graduate, and it's all a process, right? It's all a process. And if you're ready, then you know you're ready. And if you're not, we'll talk about a plan on how to get ready. Here are the big 4 questions. You want to answer those. You want to know exactly what they are. Again, as you prepare to graduate. By answering these questions, it's going to give you a sense of peace. It's going to give you a sense like, okay, I've got a plan. I know my numbers, and they either work or they don't. We'll be working off these numbers in the coming weeks. So again, make sure you've identified these questions and identified the answers as they relate to you as an individual or a couple. It's very, very important. So why 4%? Well, what we know is there's a lot of history on this. If you do it right, and I'll explain what right means, a portfolio should last 30 years or more if you keep your fees low, you minimize taxes, and you have a decent amount of stocks in a portfolio. What's a decent amount? Well, 50%, I would say at least, trying to go even higher than that. And that might scare some people. You might think stocks are scary. Well, yeah, inflation is scary too. So we've got to stay ahead of inflation, and stocks by far have been our best inflation hedge over time. They've averaged over 7% beyond the inflation rate over time. So that's why those stocks are important. And again, buying stocks within index funds or ETFs. Index fund is a way to capture a market return at a very low cost. ETF can do the same thing. You just want to make sure when you buy these index funds or ETFs, you're buying and you're holding. You're not trading often. So this is soft science, meaning 4% is a guideline. It's a good guideline. Doesn't mean it's in stone. They've taken decades and decades of returns and put them together to give you an idea of what has worked and what hasn't. But at the end of the day, there's no guarantee about the future. We'll be talking about this more in future weeks, but at the end of the day, the 4% rule is a guide that we can use. So you can use a nest egg calculator. You can go to Vanguard and do one. I'll show you that later weeks. You can also go to 4percentrule.com. 4percentrule.com. That website, you can put in your numbers. Be as correct as you can, right? Data in, data out, and make sure that data is correct. That can give you a very good snapshot of what you might expect going forward with your particular portfolio as it's created right now. So the big numbers that do work. So here's an example. Somebody has yearly expenses of $44,000. Their fixed income, so this could be Social Security, could be a pension, could be part-time income, could be whatever. But right now they're projecting earning $24,000 a year in retirement. Their current portfolio is $800,000. That's all of their money together. 4% of that number is $32,000. So we subtract 10% for taxes in this situation. Most of that money might be in a 401k or an IRA after it's transferred. And that means that equals about $28,800. Well, that $28,800 is more than it's needed. It's more than needed. So 28 trumps 20,000. That means the numbers work. That means you can pull about, let's say, 3.7% of your portfolio, and it's going to keep growing. So we like those numbers, and we want to keep working off those numbers. Here's an example of numbers that don't work. Somebody has yearly expenses of $60,000. They're expecting fixed income around 24,000. Well, now they need 36,000 to pay the bills. Same portfolio, same numbers. All of a sudden, now we're above 4%. Well, all of a sudden, that doesn't work so well. The math isn't working. And that means your portfolio could eat itself. It could run out long before 30 years. So again, this is math. We want to understand our numbers and how they fit as we look at these four big questions. So let's say somebody's not quite ready. Well, one, start reducing your monthly and yearly expenses. Pay down debt. Finding ways to spend less. You can enjoy life just as much and spend less money. So if you're ready, if you really want to graduate as soon as you can, start minimizing your expenses, paying down that debt as fast as you can. Save more, and then increase your allocations to stocks, specifically stock index funds. And so by saving more, you're going to build up the capital. And then that 4% number is going to be a bigger number because your size of the portfolio is bigger. And then the easiest piece of all of this is to cut your expenses. I promise you, that's the easy piece. By getting your expenses very, very low with index funds or ETFs, you can dramatically increase your returns over time. That's not an opinion, that's fact. There's not just a correlation, there's a causation between how much you pay in fees and what you get in returns over time. So, becoming the great saver. Cut expenses, increase savings to at least 20%, right? So you're planning to get there. This is going to get you there faster. And if you want to save more than 20%, go for it. Again, take those savings, pay down high interest rate debt. What is high interest rate debt? Well, in my mind, it's anything above 6%. Get rid of it as fast as you can. Invest wisely in those index funds and ETFs. We'll be talking about them a little bit more in the next couple of weeks. But the bottom line on this is you want to make sure that you're paying the minimal amount of fees when investing your money in the stock market. And when I say casino versus gambler, what I mean is when you walk into a casino, if you do, hopefully we all know that the odds are against us. Can the gambler win? Yes. Is it likely the gambler's going to win? No. It's likely the casino's going to win. It's almost guaranteed the casino's going to win in the end. Well, index funds are the casino. You put the odds in your favor owning an index fund portfolio where, yes, some managed mutual fund, some person, guy, whatever, could pick the winning fund. That's not an index. That can happen, just like a gambler can win, but consistently over time, they will lose. Index funds win. So play the odds, become the casino. And why do you do all this? Well, because you want to graduate as fast as possible. That was my motivator. If I could have graduated at 40, I'd have done that. So the reason why you make these sacrifices, you implement them in your life, and you continue down this road of action is because you want to get to a better place where you have more freedom to do the things that you want to do. You are designing your future life. Becoming that great investor, it's not that hard, to be honest with you. You invest in broad market stock index funds. So you can own a Vanguard total stock market index fund with a expense ratio of 0.04, where you own a piece of every publicly traded company in the United States. You would own the United States in one fund at a very low cost. You could also own target date funds and own a combination of stocks and bonds all over the world. And for some people, that can work. I'm not necessarily a person who promotes those, but for some people, that could be the option that works best for them. And we'll talk about them in the coming weeks. Transfer your money. So if you've identified that your funds are somewhere else with high fees, you want to get those monies transferred over, roll them over into an IRA at a place like Vanguard or Fidelity or Schwab into low fee index funds. Start taking control of your money, start consolidating your money so it's simple. Keeping this situation simple is a good thing. And of course, keep a good portion of your money in stocks because you know that inflation is the enemy, not the volatility of markets. Markets will always go up and down. We've got to stay ahead of inflation. Stock market does that better than anything else. Taxes. We'll be talking about taxes. You might expect a 10% federal tax on your money if you live in Iowa. There's no state income tax if you're age 55 and over, starting in 2023. If you do not live in Iowa, or you'll have to look at your particular state, how they tax you, but you want to factor in taxes when you're looking at your bigger plan. And again, could you be taxed more than 10? Yes. It's based on how much money you're pulling out, whether you're going to be in the 24% bracket, 22, 12. There's a big difference in the federal tax brackets based on your income for that particular year. And we'll talk about that in further coming weeks. Will you retire in a low tax environment like Iowa, Tennessee, Texas, Florida, or will you end up retiring in a high tax environment, California, New York? There's many places. Minnesota isn't a very good place to retire when it comes to finances. So understand your location and why you're choosing to retire there, and then what is the financial ramifications of that? And will you need an accountant, or are you going to handle it yourself, right? At the end of the day, you figure that out. You might be a do-it-yourself kind of person. Good for you. I am. Otherwise, you might want to be finding a good accountant because as you enter this next phase, the bad news is it gets more complicated. You have more moving parts as we age. And so a good accountant could be worth their money. Again, case by case. Your home. What are you going to do with your home? Many people will own their home when they retire. How much equity do you have in your home? How much do you estimate you will have in equity at retirement? Is it going to be paid off? Are you going to still have a loan? If so, how much? Are you staying put, or are you going to be moving from that home? Are you going to be downsizing? And if you do downsize, are you going to buy another home? You're going to buy a condo? You're going to rent a condo? What are you going to do? And if you do rent, what are you going to do with all that equity? Where does that go? So we'll talk about that because these are very, very important questions that need answers. And are you going to get a reverse mortgage? Is your goal to stay in your home as long as you possibly can? A line of credit, possibly? Is that your plan? If not, okay, what is your plan? You want to have a plan for your home and how you're going to deal with it. Your debt. So what debt do you currently have? What is the interest rates on that debt? What are your payments? How much debt do you expect to have at retirement? As a good rule of thumb, you want to get rid of all of your debt prior to retirement. The mortgage might be the exception. You don't necessarily have to be debt-free, but you want to minimize your debt leading into this next phase of your life. So will you pull from the portfolio to pay off debt? And what about opportunity cost, right? So if you're pulling money from a portfolio, because I get this question on occasion, should I pull money out of my IRA to pay off my other debt. Well, what is the interest rate on that debt? Well, my interest rate might be 3%. Well, if your IRA is earning 8, the answer is no, because you're also going to have to pay taxes if you pull money out of that IRA. So you're weighing this. There's no perfect answer. You have to look at each situation and figure out what's the right move at the right time for you. Because opportunity cost is at play. Money earning 5.28, which is what the money market fund at Vanguard's earning currently. Doesn't make much sense to pull money out of that to pay off a loan, let's say at 3%. Better to earn 5.28 than to earn 3% paying it down early. That's opportunity cost. Every dollar you have, where can it be working for you most efficiently? Social Security. How many benefits do you have? Some of you might think, what does he mean by that? Well, you might have 1, 2, 3, 4 different Social Security benefits. So the program is big, it's expansive, and you want to understand Social Security and the many benefits that could apply to you at different stages of your life. What is the right strategy based on your situation? So you can only have one benefit at a time, but you can take a benefit and then drop it and then take a different benefit at the right time based on circumstances. So at the end of the day, you want to identify your Social Security benefits and then start coming up with a strategy on how to take them at the right time for, again, an individual or as a couple. How long will you live? I get this often. People say, well, I could die tomorrow. Yes, you could die tomorrow, or you could live to 90. And so at the end of the day, there's a thing called longevity risk, the risk of living a long time. We have to protect ourselves from living a long time. And so when you're making these decisions, if you have a spouse, you want to have that conversation with the spouse. Because at the end of the day, there's no crystal ball. It's going to tell us how long you're going to live. We've got to plan to live a long time. Because if you hit 90, you'll be glad that you planned for it. And if you don't make it to 90, say you end up kicking the bucket at 72, well, guess what? You have no more problems. So it would be wise to plan beyond 90, right? Because being old and poor sucks. And I don't want any one of you calling me when you're 90 saying, Finley, I'm out of money. Well, see, so I'm gonna play it safe. I'm gonna give you a conservative strategy to make sure that you have enough money where the money lasts longer than you do. That immediate annuity, will you buy one? Again, it's buying a pension. That may or may not be the right option for many. We'll talk about this in future weeks. What kind of time period would you consider? You could buy one for a 20-year time period. You could start it later in life, earlier in life. You could pull money out of an IRA, out of a brokerage. Again, opportunity cost is at play. Longevity risk is at play. Getting a guaranteed amount every month, kind of like a pension, might work for some people in different situations. You have to evaluate each option, try to make an informed decision based off your situation. Again, we'll break it down in future weeks. Health insurance, what are you going to do? Will there be a gap? So when I say a gap, let's say you want to retire at 60. Well, Medicare doesn't kick in until 65. What are you going to do from 60 to 65? Well, for many people, it could be Obamacare, the marketplace. It could be Cobra, but I can tell you Cobra is going to be pretty expensive for 18 months. So the marketplace can be a very good place to get health insurance leading up to Medicare. The marketplace is an income-based healthcare plan, income-based. It doesn't matter how much money you have, it's the income you're receiving on a yearly basis that's going to decide your premiums for the marketplace. There's many opportunities to get those premiums down to little or nothing and have good health insurance. So you want to have a very clear-cut plan on health insurance if you're not going to be 65. And again, Medicare kicks in at 65, and then we need to plan and prepare for that. We'll talk about Medicare when that time comes. And again, what does Medicare cover and what does it not? And again, knowing the details, knowing where to go to learn more and understand your particular situation. Long-term care. This is a risk for some, and it's certainly a fear for many. What is it? Protects you, so to speak, an insurance plan that helps you take care of your situation, whether you're in assisted living or a nursing home. Question is, do you need it? Well, maybe, maybe not. And if you do need it, how much do you need? Can you afford it? Because those premiums can go up over time. In many cases, they do. And when do you get it, if you get it? And maybe you're self-insured, meaning you have enough money to take care of you and or spouse if you were to go into a facility. We'll talk about these numbers. We'll talk about the specifics in the coming weeks. Life insurance. Do you need life insurance? Well, I would tell you the majority of people who graduate do not need life insurance. We'll talk about that because, again, it's supposed to protect you from the loss of, let's say, income. Well, if the income has gone away, then life insurance is probably not needed. And if you have cash value life insurance, you might want to cash that out because you might be self-insured. If you have inexpensive term, even though it's not costing you much, you might want to get rid of that because you don't need it. So again, we'll talk about the specifics of that. Again, maybe you get rid of it. And if you do need it, how much do you need and what type? All these are important questions. We'll go through them step by step in the coming weeks. Estate planning. Is your will updated? Do you have a will? You want to make sure that's all where you want it to be. Do you need a trust? Well, maybe you do, maybe you don't. We'll talk about that. Do you have a death file? A place where you put all your information so your loved ones know where to go to identify where your money is located. These are discussions we want to have with our family. We want them to know this information rather than when you pass hunting around all over God's green earth trying to find where dad's or mom's money is. You can do a great service to your family by giving them a death file and keeping your money in one central location so the process is simple for them as they go through the grieving process. And again, having that discussion. Most people do not talk about death. We don't like talking about death, even though it's going to happen. So I encourage you to have these discussions and get your plans together, explain your plans to your loved ones so you and them understand what's going to happen when that day comes. And it's going to come. I haven't figured out how to get out of that, and I don't think you have either. Resources. So my third book, What Colors the Sky, is my book on investing. If you want to learn more about that game. And then Graduation is my book on retirement. Graduation is going to help you with this course. This 8 weeks is basically the book Graduation. So reading the book and taking this course is going to help you follow along. The language to money is in the back of each book. So there's a glossary to help you with terminology and definitions. Jane Bryan Quinn's book, How to Make Your Money Last, is a very good retirement book. I encourage you to watch the Retirement Gamble documentary on YouTube. It's a PBS special, The Retirement Gamble. It does a very good job of explaining the system, the financial services industry, how it works, and if you're not careful, how it can take advantage of you. And then if you want to learn more about Social Security, Get What's Yours. Get What's Yours is a book. Make sure you get the updated version, but Get What's Yours is a great book on understanding Social Security and its many benefits. Fred Rogers said it well. So what I would tell you is, in many respects, my life started when I graduated. So it's not the end, it's the beginning. Okay, folks, what questions do you have? I'll take a look here at the chat. Okay, I have nothing. Any questions you have, feel free to unmute and ask your questions or put them in the chat. Come on, folks. I'm sure there's some questions out there.
I have one. You mentioned, Michael, about a death file, which is a great idea. In my case, my attorney has all my information, passwords, passcodes. I have a copy of all those in my bank safety deposit box. Um, I picked out my executors, two of my nephews, but my lawyer is more informed about where everything is, my investments. Is that enough, or should I be doing more?
Well, I think you've done great. I think I would just have an extra conversation with the executives. Make sure they know clearly, they know who the lawyer is, they know how to contact the lawyer, and they
Yeah.
have a basic understanding of your situation. But I think you've done a great job.
Okay, thanks.
Any other questions?
Mike, this is not a question, more of a comment, but thank you so much. This is the second time that we've been through this program, and I can tell already we're going to learn again. Thank
No,
you.
that's wonderful. Yep. And as I say this often, if you've spent much time around me, a lot of times these classes, the books that I recommend, you want to expose yourself to it more than once, because it's not that the information changes dramatically. It doesn't. It changes slightly. What changes is us. When we are exposed to new information, we change, and then when we get that same information thrown at us the next time, all of a sudden we're processing it in a different way. Okay, Mike, are your books available? They're on Amazon. So you can complete list of books you look up. Yes, so they're available on Amazon. That's where I would go, Mike Finley books. And yes. So my books, again, what I try to do, I write books for the average person just kind of getting started. I try to provide you definitions and understanding, and then you can build off my books. That's kind of the idea. I'll be recommending a lot of books coming weeks, but getting started with mine is a way to kind of get the basics down. Those age 55, yes. What year did, I think 2023, that no longer applied. So if you're age 55 or older in Iowa, your IPERS benefit is not taxable at the state level. Traditional IRA, not taxable. Traditional 401k, not taxable. Qualified annuity, not taxable. So in the state of Iowa, no tax on your retirement savings once you've hit age 55. Okay. Well, let's proceed. Oh, we got something else here. Who can you see? Mike, did you say that there? Yeah. Okay. We're good. We're good. Okay, folks. I'll finish with some information and then my story. So next week, identify the answers to your questions, right? Go get the information on your portfolio if you're not sure, and then we can talk about that next week with any kind of questions or concerns you have. You can email me at MikeFinley@thecrazymaninthePinkWig.com. You can go through my website if you like, and I can help you further on an individual basis. Show up with those questions and we'll talk about them. Discuss investing. That's what we're going to be talking about next week. How to put together a portfolio, how to put it together now, and then what's it look like in retirement. Start reading the recommended books. I would encourage you to immerse yourself over these next 8 weeks. Just really dig in and learn as much as possible. I promise you, you'll come out the end much wiser, and it's going to help you with some of your fears or concerns because you'll have the knowledge of what you're doing and doing it right. Some final thoughts. Knowing your numbers will reduce those fears. Having a plan will increase your confidence. Working that plan will put you in control, and financial freedom can follow. So, do you need to sign up? You'll need to send me an invite again each week for the retirement class. Send me an email and I'll respond with that next week's invite. Generally speaking, I would just wait until the beginning of the week. So Monday, Tuesday of next week, Wednesday is fine. Just shoot me an email and I'll send you that week's invite. So the Giving Solution, that is my nonprofit. I'm the executive director. We provide a free education. That's what you're getting here. And one-on-one assistance. We will help you at no cost with your personal finances. Again, the time to start is now. Don't wait, folks. Don't say one day. The time to get moving is now with action. Your future self is waiting, and he's waiting, she's waiting for a better day. TheGivingSolution.org is our website. You can go there to reach out to us. But at the end of the day, we will help you at no cost, whether you have 5 million or $5. Okay, I'll finish with my story for the night. It's called The Ship. So the ship, we got 4 people on this ship, and they're taking off. And they're looking for land. And they're trying to find the best piece of land. And the first guy, he's looking and looking, and he's looking for the best piece of land. And he's not quite, he's just not seeing it. So he never gets off the ship because he never finds the perfect piece of land. The second guy, he kind of wings it. He looks up and hey, that land looks good. He pulls the ship over, gets off, boom, he found his land. The third guy is a little more pragmatic. He's looking for a good piece of land. Doesn't have to be perfect, but it needs to be good. So he finds the piece of land. He has the ship pull over. He tells them to tie it up, don't leave. He's going to go check out that land and see if it's the right land for him. And maybe it is, maybe it's not. And then we have the fourth person. This fourth person's a lot like the first person. Except they're self-aware. They kind of know that they're always looking for the best piece of land and they'll never get off. And because they know that, they do something the other 3 didn't. They burn the damn ship. They burn it while they're on it, forcing them to get off the ship and onto land. So, this story is about our work and our graduation. And each one of us has to figure that out. We all have to figure out what is the right time. And, you know, folks, we can work till we're 90, or we can try, or we can step out and do something else with our lives. Ultimately, it's up to us as individuals to figure that out. And it's the math and psychology that goes behind it. And over these next 8 weeks, I will help you with both. Okay. Well, thank you for attending, and I hope to see you next week, folks. Bye-bye.